If you're a homeowner, pay close attention because this video could save you a lot of pain in the near future. The Canadian housing market is very frothy right now, and I mean very frothy. We're approaching bubble territory, especially in Vancouver. The Bank of Canada is set to raise interest rates up to 7 times this year, and that would put us at 1.75% at the end of 2022. Guys, housing prices fall 10% for every 1% increase in interest rates. And I'll show you some stats right here. But what that means is we're looking at a potential 20% fall in housing prices. Now, that could happen, it might not happen, but the fact is that housing prices in Vancouver are rising at 3% per month. That's an annualized 36% increase. Toronto, Calgary, and many other major areas in Canada are also rising rapidly. So, should you sell your house and start renting while you wait for the inevitable bubble to pop? Good luck timing that one perfectly. Fortunately, there's a better way, and in this video, I'm going to show you how to take advantage of increased housing prices without having to sell your home. Let's begin. Okay, let's start with option 0. That's selling your house. Well, the benefits of selling your house in a time like this is that you're going to have cash in your pocket and you're going to have lots of upside if you're highly leveraged and your house prices increase significantly in the past few years or months. Some of the drawbacks of selling your house are obviously that you'll have to find somewhere new to live. You have all the moving and transaction costs associated with the property, and it's really just inconvenient to uproot your whole life. So maybe selling your house right now isn't such a great idea because if you sell your house and housing prices keep going up, you're basically screwed. There's nowhere for you to go and you're going to have to rent and maybe you won't be able to buy again. All right, well, let's move on to options 1 and 2, or basically what I'm thinking you could do. So your first option is to refinance your property with another lender. The benefits of this is that you get a new mortgage interest rate and you're able to cash out with your refinance. Some of the drawbacks could be that you're going to be subject to penalties from your existing mortgage broker. So if you just got a rate like we did, then if you try to refinance with another company, your mortgage broker could actually charge you huge penalties for breaking your mortgage contract and trying to leave to go to a new lender. Also, your new mortgage rate could be higher than your rate right now because the banks are anticipating increased interest rates from the Bank of Canada. So that could mean that we're going to see increased mortgage rates as well. So maybe you're not going to get such a good rate. Well, that brings us to option 2, and that's the answer of this video. This is the thing you've all been waiting for. The home equity line of credit. Okay, so what the hell does this do for you? Well, you can get a home equity line of credit through your existing mortgage broker. And the benefits of this is that you're not going to suffer any penalties, so you're not going to have to pay the bank additional fees likely. You're going to be able to cash out immediately. You can actually keep your home and you can keep your current mortgage rate. Now, there are some drawbacks to this, and I'm going to go into these in a bit more detail. We'll talk about the benefits and the drawbacks. But basically, what you're doing is the fact that housing prices have gone up so much, you're going to be able to take advantage of that, pull money out, have that money available for you to invest or spend if you really want to do that. And you're not going to have to worry about actually selling your property. Now, some of the drawbacks, and there are drawbacks of having a home equity line of credit, are that it's probably going to require a property reassessment, which could cost you around $400 to $500. And your lender might actually freeze or lower your line of credit if your home's value has a significant drop in the near future. But if you're going to take out all the money out of the line of credit right away, then that's not going to impact you. It really only impacts you when you go to sell the property. All right, so how does this work? Well, let's run through an example, and this is similar to something that's happened in my life, but it's not exactly the same. So let's say you bought your house for $1 million in 2021, and now the property next to yours in the same complex that is 400 square feet smaller just sold for $1.4 million. Wow, your place just gained value. Maybe it's worth $1.5 million now. That means you have grown your equity by $500,000. That's insane. Of course, if you sell your house now, you'll net that $500K minus selling and moving fees, but you'll also have to find a new place to live. And if housing prices have gone up that much, you probably won't find anywhere comparable for a lower price. So, are you out of luck? Fortunately, no. You can probably get something called a HELoC or home equity line of credit through your mortgage lender or another lender. A HELoC allows you to borrow against the equity in your property and take cash out. This only has to be repaid when you sell your home, although interest accrues as you take out money. This is essentially a credit card that is secured against the value of your home. That can be a good or bad thing depending on how you use it. If you use it like an ATM and buy depreciating assets or junk with your HELoC, that money is gone and you still have to repay it. However, we're all about growing our wealth here at Modern Finance. That means we're going to use this equity to generate more wealth. That's right, we can take the HELoC and reinvest it. I think this could be an especially good strategy right now, hashtag not financial advice, because house prices are rising so rapidly right now and they could easily fall quickly when the Bank of Canada raises interest rates. If you want to keep your home but still profit from the temporary price increase, this could work for you. Once you have the HELoC, you probably don't want to YOLO into tech stocks, unless it's a diversified long-term play that you're pretty confident will yield you a greater return than the interest rate that you're paying on the HELoC. Be careful. You have to pay this money back when you go to sell your house. It's not free cash. I'm not sure that the stock market has bottomed yet, and we could see further drops throughout 2022. So just remember, invest cautiously and invest wisely. With Russia's invasion of Ukraine, continually rising inflation, debt to GDP approaching 400% in Canada, and the possibility of COVID measures returning with any increase in cases, there are lots of opportunities for things to go very badly very quickly. So here's what I'm doing. I'm going to get a HELoC and use it to buy long-term hold investments inside my TFSA, as well as some gold and some crypto, and possibly an inflation hedge bond or two. When the Bank of Canada raises rates, housing prices will stall or fall fairly shortly after. If I've timed this right, I'll have access to a bunch of money that I can invest and grow, even while our house loses value. Since I'm planning to live here for the next several years at least, hopefully housing will have regained any losses that take place before I go to sell the house. If I haven't timed it right and housing prices keep rising, it's good too because I'll still have the assets and the HELoC, and hopefully my investments also grew in value. Seems like a win-win to me. As long as you're investing and not spending your HELoC and your investments don't tank, it's a good way to have funds on reserve available if the proverbial shit hits the fan. It's also a good way to take advantage of rising house prices to increase the size of your investment portfolio without selling your house. Of course, if you're going to do this right, you need to know which assets to buy in crazy economic times like these. Check out this video right here where I describe how to build a portfolio that can perform well under any circumstances. For now, guys, that's all. We'll talk to you in the next one. Peace.